Hi, I'm Byron Moore, and this is my partner Mike Jones, and we are coming to you with a fourth quarter economic update for the year 2023. And Mike and I talked a couple of weeks ago about shooting this video, and when I did, my friend Bill came to my mind. He said, you know, Byron, you guys never send out a video unless something's wrong with the market. And I thought, Mike, we got Bill this time because nothing was wrong with the market. In the last 2 weeks, we got an interest rate correction in the market. So Bill, you're right. But that's not really why we're here. Really, the reason that we're here is just to give you an update on kind of how things are going, both right now and really over the last few years, really since COVID changed life as we know it, and to give you a kind of a forward look of the way that we see things. So I think a great way to kick things off, Mike, would just be give us just a little overview of, when I say the word investing, what am I talking about?
Yeah. Byron, as we build and construct things for our customers, you're going to find that there are three big building blocks to a person's investment account. And we've had these conversations with clients for years, but it's always good to go back to the beginning and do just some simple explanations. The money market portion of a person's account, kind of what we call the cash portion of a person's account, is just for stability. And fortunately, right now, we can earn very attractive interest rates on that. Then for income, and really just to give some ballast, it's almost like putting the rudder on the boat, putting some ballast in the boat as well. We will use bonds. On your statements, many times you will see the term fixed income. These are just the interest-bearing securities that we hold for you in your account. Then the part of the account that over time you'll notice has been the growth engine of the portfolio, the common stocks or the mutual funds of stocks, then those mutual funds and those individual common stocks represent ownership in businesses. And of course, as those businesses expand and do better, the value of those stocks expand and do better. And that's what drives portfolio returns.
Okay, great. So we obviously take those three components, the cash, the bonds, and the stocks, and we mix those together almost like a recipe. And we want to put a portfolio recipe together that's appropriate for each person's age and their stage in life and what it is that they're trying to do and even their temperament. Mike, when it comes to the stock portion, that what you just said kind of drives growth. I know the answer to this, but are they all the same or are they a little bit different?
Yeah, think of just a big old square, almost like, for those of us who can remember, Hollywood squares, all right? And that being a matrix, and there being boxes out there, you know, in that matrix, and those different boxes are different types or styles of stocks. What I thought would be valuable for this video today would be to show you some charts or some examples of the styles or the boxes that we at Argent Advisors tend to use the most. So we pride ourselves in working with people as wealth managers. And they don't have to be wealthy people, but we want to take the concept of what a wealth manager would do. And so what we would like to show you would be three examples of investing. The first one you'll see would be a chart of investing in a particular box of the stock market that would represent high dividend paying, primarily blue chip stocks. And the main thing that I want you to notice is how, going back over time, the success does look tremendous. This has been a great way. If you need income, particularly in retirement, and a buffer to the market going up and down, then this is a component where we build portfolios of individual stocks to represent this box of the market.
Okay, and this is a 20-year chart we're looking at now.
This is a 20-year chart we're looking at. The second one that I would want you to see would be something where you're still in wealth management type of stocks, blue chip type of stocks, Dow Jones Industrial Average type of stocks, and more. But I think this chart of the Dow Jones Industrial Average would be so representative of what we try to do for people. And once again, you will see that it has grown and grown very nicely over time.
Okay. So talk us then. How about when we mix stocks and bonds together? What does that do for us?
So we do mix them, and sometimes depending on a person's goal and their investment temperament, we'll go a little more, a little less. I think what you put together for our video today is a 60% stock, 40% bond portfolio, and you can see, yes, the growth isn't as dramatic as in those first two charts, but the volatility, the ups and downs are less. But the trend, here's the key, the trend is the same. Over the long term, it has worked, and it's worked very well.
And of course, we have to say that historically, markets have worked over long periods of time in our favor. That's what we have great faith in. No one can guarantee that, but that's what's been the historic trend for the last 100 years or so. So Mike, we're not investing in nothing. We're investing in this engine that primarily is the United States economy, but also we broaden out from time to time and invest in things that are outside the United States. But we're looking right now at a representation of this little 3% of the world's population, which produces about 43% of the productivity or the stock market size, the capital that's been created in the world. We represent about 43% of that right now, which means that we're the leaders, and we're kind of punching way above our size, if you will. Others are catching up, which is really great news because it makes more for all of us. But right now, as we see the United States economy over the last, let's just say again, 20 years, Mike, how would you say that the U.S. economy has performed, relatively speaking, over the last 20 years or so?
Yeah, well, it has been amazing.
Okay.
It hasn't been maybe the starts and stops, the fits of many, many, many decades gone by. Yeah, we think back into the 1800s, and it was pretty wild. But our engine is big now, and it has grown in scope of trillions upon trillions of dollars. If it's grown upon trillions of dollars, the investments in that economy have grown as well. And that's why it's just been such a good ride.
So investors in that have gone along for that ride and have experienced that. So that's really what we're investing in, is the economy and our faith in the growth of the economy. The fact is there's lots of factors at work, and everybody wants to try to put their stamp on it. And so we're in this really unusual season right now where we've got one side of the government that's responding to a very real bout of inflation. And then there's another side of the government that says, no, we really need to step on the gas. So we've got, as we were saying before, somebody stepping on the brakes and somebody else stepping on the gas. What are those two components, and how are they working kind of against each other right now?
Yeah, and if you've ever driven behind somebody where you know that's what they're doing because they're going down the road with their brake light on constantly, and their speed is changing. I think your analogy is very apropos. Let me explain that a little bit,
good.
Okay? Because if you take a look at this particular chart that comes from J.P. Morgan Chase, then you will see how aggressively the Federal Reserve has raised interest rates, okay? And so, in fact, it has been the fastest raising of interest rates, rising interest rates in our Fed's history.
Almost straight up, it looks like.
It does. And so, and very interestingly, this chart, which is, I think, of extreme importance for us right now, kind of shows, one, where we've come from, where we are. You see Fed funds rate on the chart of 5.38%. Then you see what the Fed is predicting, where they predict they will go with interest rates, as whereas the futures market, where it predicts interest rates will go. And from that, it does look like we're kind of at or very near the peak of this. Now, the reason why we bring this up is, we all know rising interest rates slows down the economy. It puts brakes on the economy.
Right.
It's harder to do things when it costs you, well, go to the bank right now and try to get a loan.
Exactly.
Right?
Yes.
Okay. What most people aren't aware of is on the other side of the fence, Congress, the White House, there have been stimulus packages, there have been infrastructure bills. I think you've got a few of them.
Some of those are scrolling on the screen right now. And as the old saying goes, $1 trillion here and $1 trillion there, and before long you're talking about real money.
Yeah. So all of a sudden, all of this money has been allocated to go into the economy, to build bridges, to build chip factories. And so people are wondering, like, why, with interest rates so high, why aren't we in recession? And I think when you see the numbers, you realize, oh, that's a big part of the reason why we are not, okay? And so as a result, the economy is doing better than most people think. Doesn't mean that it's not facing a slowdown, and possibly in the very near future. But I don't think it's going to be a severe one, which, coming on the backside, leaves even more room for growth in the future.
There you go. So, Mike, is there anything that Mike and Byron can do about Fed interest rates?
No.
No. Anything we can do about the government wanting to pour trillions and trillions of dollars into the economy?
We are hopeless from Ruston, Louisiana,
right.
in controlling that lever.
That's right. But what we can do is manage your portfolios to the best of our ability, which really means the construction of that portfolio and the day-to-day management of it, doesn't it?
Yeah, it does, yeah. And before we end this video, I would like to go back or circle back and have you look at this, one of these earlier charts that we put up.
Yep.
And notice how after a series of a nice number of years of things working well, there's been kind of a stalling out. It's not disastrous, but if somebody hired us as a manager 2 years ago, or almost 2 years ago, they might look at their portfolio and go, well, we haven't made any money, or we haven't really moved very far. And I think by looking at the chart, looking at it over that time frame and then long term, two things will happen. One, you'll go, oh, I see why that's the case. And the other is, oh, but if I hang in there, I think there could possibly good things could come in the future.
So we like to say that we'll do our best to provide the portfolio know-how. What we can't provide is the patience, and the patience is what you've got to provide. So we are, I think, cautiously optimistic about the immediate and very optimistic about the long-term future. But what we also are is available to talk with you at any time. So if you have any questions, we invite your phone call, your emails, and as always, if anything changes in your situation, please notify us so that we can make any appropriate changes in the way that we're managing wealth for you. But until next time, for Mike Jones and Byron Moore, we want to wish you the best of the last of 2023, and we'll see you soon.